Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we are entering another week of what is a volatile trading week that has been sparked off by news events here. A few weeks ago, we had the news out of China with regards to the DeepSeek AI model that sent shockwaves around the US equity markets with regards to concerns of how much US tech companies were spending on AI infrastructure. I would say that now that we've had a bit of time to digest that news, I think we largely agree that the initial sell-off here, especially in some of the names like Nvidia, was a little bit overdone or a little over exaggerated in regards to the impact that that news has on the overall outlook here for AI infrastructure spending and just AI spending overall. Even though I will say it does have it will and has an impact on the overall markets, but just that the initial sell-off that we saw here um, was a little bit overdone. We've seen most of that kind of correct itself already by at this point. Um, Last week we opened up the markets where the markets were a little bit more spooked on the back of tariffs that President Trump was slapping on China, Mexico, and Canada. But with quickly reversing some of those threats. We saw markets kind of recover. It was a bit of a choppy week here. And this week, once again, we start off the week here on the back of tariff news. This has all been within the backdrop of, what has been some major economic news or events that have come about with regards to US GDP, FOMC meetings, inflation data, all of these things that have largely continued to, that investors have had to digest with regards to how it changes the outlook here for the US equity markets. And, on balance, when you look at kind of how markets have digested everything, what's interesting is that effectively since November, the US equity markets have largely been unchanged. We really haven't seen much in terms of progress here for the US equity markets for the past 3 months. Um, Certainly has been some volatility in that period of time, but in terms of overall progress for the US equity markets, we really have made no progress. So, at the moment, that remains our base case. And when we trade at the top end of that range, that certainly leads us to believe that in the short run, there could be some further volatility here, especially as uh, news with regards to tariffs this week continue to evolve. If we look at market breadth here of the overall equity markets, they remain relatively poor and continue to deteriorate, which is a concern for US equity markets. If you see the NASDAQ 100, just like the S&P 500, largely trading sideways here for the last few months, and deteriorating market breadth continues to put the outlook here for the U.S. equity markets here at risk, and we continue to at the moment expect more sideways movements here from the U.S. equity markets unless we can break out above some major resistance levels or break below some major support levels. And here at the moment, we don't have either one quite here on the tables just yet. You have IWM that recently was rejected the 50-day moving average, and you also have the 50-day moving average starting to slope lower here. So what you have is resistance that are starting to decline, which certainly would potentially lead to further downside here for small caps or in IWM. You have RSP, equal weight S&P 500 index, also failing to break above that 50-day moving average in any meaningful way, which certainly risks some further downside here in in the equal weight S&P 500 index versus the market cap index. So this is something that we are continuing to monitor here for kind of how that affects US equity outlooks. If you look at kind of how growth versus value has performed, we saw growth outperform value by a pretty significant margin here towards the end of the year. But we really have seen value continue to outperform growth in the short run. But we have seen commodities break out here to the upside and continue to form a base and actually build off of that base and actually start to trade higher from that level. And then we have high yield corporate bonds that have actually continued to rise. And this provides more of a risk on backdrop here that we continue to see here for US equities. The bond market, a high yield corporate bond market, continue to provide that that risk on environment, meaning that the corporate market, the credit market is not concerned of some significant downturn here in terms of credit. And that's something that we will continue to monitor here for US equities. With the VIX kind of trading below 16% here, this is something that we are concerned about here. The fact that you have the S&P 500 at all-time highs, but the VIX trading at still trading in the 16% range is something that we have to be concerned about as to whether or not investors are still a bit fearful here for US equity markets. The 10-year yield continues to provide a bit of a challenge here or headwind for equities because the fact that we are still here um, um, the fact that the 4.5% is going to provide that headwind for both consumers, government, and corporates as higher interest rates have continued to take a drag here for, uh, you know, the size of the US budget, the size of the amount of capital that consumers have in terms of discretionary spending, and even corporations and how much debt they have to take on or roll. And the cost of that debt here is going to be a drag here for US equity markets and continue to be a drag here for the US equity markets here in the short run. You have the dollar index continuing to find support and rallying from here, which is arguably better for the US with regards to kind of some of the concerns around tariffs. A stronger dollar helps offset some of the risks here for US consumers. And gold has sparked its rally here after breaking out above 2,800 here to the upside towards that $3,000 level here. So gold continuing to rally here, especially with oil kind of finding some of that support here around 71 and bouncing off of that. This has provided an environment that is supportive here for commodities. And then if you look at kind of sector rotation, this is something that we've seen a lack of rotation here for the most part since the election. We started to see a little bit more rotation here a few weeks ago, but we started to see that kind of reverse back here again. Um, and then so for example, if you see technology that has largely been trading sideways here has started to now, see some rotation out of technology. We've seen consumer discretionary start to lose some of that strength here over the last few weeks. But communications, as you can see, continue to be one of the strongest sectors here right now in terms of strength. Financials, one of the strongest sectors here in terms of strength. And then if you look at consumer staples, we continue to see outflows from staples and from a relative performance perspective. Healthcare starting to roll over here again. Um, Materials starting to roll over here again after what has been a couple of strong weeks in terms of performance. Industrial starting to lose performance here again after what has been a couple of strong weeks. And then real estate, stabilized a little bit here. We'll see if that can continue. But, so far in the long run, especially with 10-year yields above 4.5%, we expect real estate will continue to be a challenge for real estate. If you look at energy, Energy has continued to underperform the S&P 500 by a pretty significant margin. Same thing here for utilities. So all the sectors that have underperformed have continued to underperform, despite the fact that over the last 3, 4 weeks, we started to see a little bit more rotation, which was generally healthy here for the equity markets. But that rotation has largely reversed back to kind of the directions that we were seeing before. And that's a deteriorating market breadth that we continue to see, the underlying internals that we are concerned about with regards to kind of the health of the US equity markets and where they stand. Um, Home builders have continued to underperform the S&P 500, and even semiconductors. What has started to look like a bit of strength here from semiconductors, we've seen that deteriorate here again. So just overall, the U.S. equity markets remain a challenging environment here at the moment. Um, all right, I need to take a quick pause, and I'll be right back. And what we'll do is we'll review kind of the trade ideas here for the So then within that backdrop, looking at trade ideas here for the week, some of the ones that we started to look at here this week, the newest one that we wanted to point out here is Kinder Morgan. We've seen energy prices decline by a pretty significant margin here recently. And Kinder Morgan's interesting because, as you can see, we continue to make higher highs in terms of Kinder Morgan, but we failed to start making higher highs from a momentum perspective. And this is one of the first signs that potentially, this is near a market top, when we start to see that negative divergence here for momentum. And this is really where we start to see some potential downside for Kinder Morgan. You've got what looks like a bit of a head and shoulders top here for Kinder Morgan, and this is where we're starting to target, a potential breakdown here below $26, down to around 22 or so. If you look at Kinder Morgan from a valuation perspective, we continue to trade at a valuation that is um, substantially higher than its peers. Kinder Morgan trades at about 30% higher valuation than its peers. And that's really kind of where I think there's some downside risks here for Kinder Morgan from a fundamental perspective. So I'm looking at this overall. Um, some of the energy names here that we're starting to see here after what has been a strong rally here in oil prices have started to look a little bit more expensive here to the upside. So Kinder Morgan is one of our picks here, our new trade ideas here for the week to the downside. Sorry, guys, 1 minute. Sorry, guys. I apologize for that. So Kinder Morgan is one of our top picks here for the week. Looking at other ideas, CME reports earnings this week, tomorrow, actually. And this is one of our top performing stocks here recently in the financial space. As you can see, CME kind of recently broke out from, call it a double top here, around 240 or so. Kind of broke out to the upside, came back to retest as support. And this is really where I think there's some potential further upside here for CME. As you can see, as it breaks out to new all-time highs, it is outperforming the S&P 500 as it does so. And this is really where I think the technicals align fairly well from the fundamentals here. You have you have you have a stock that's trading at about 22, 23 times forward earnings. Yet, if you look at net margins here for CME, it trades, it has net margins north of 55%. This is something that we generally don't see here from a lot of companies. Yet CME, for every dollar it earns in revenue, generates more than 55 cents in terms of net profits. And that's been a primary driver here for valuation here for CME. It's not on everyone's radar. They operate the world's largest futures exchange, and as futures trading, especially with Bitcoin and volatility products like the VIX, uh, continue to be a fairly volatile product during Q4 of last year. That's where I think that there's a possibility or an increased possibility of CME of beating earnings here this week. And that's why we're taking a bullish view of CME going into the earnings announcement this week. And that's why it's one of our top ideas here for the moment. Another one I want to take a look at here is something that we've been talking about here for the last few weeks, but despite the rally we've seen here in Meta, it represents still one of the best opportunities I still believe here in the tech space. Meta, as you can see, recently broke out multiple times. It broke out from this 540 double top, broke out from the 600 double top, and then recently broke out again from the 640 double top. It has now had 16 sessions of back-to-back gains on Meta. So this certainly in the short run looks overextended here, but this is really where I think any pullbacks here present a great opportunity to be buying Meta. As you can see, Meta currently trades at around 27, 28 times forward earnings, which if you look at the growth metrics for Meta, which is well into the high teens, low 20s with regards to EPS and revenue growth. Profitability metrics around 35% net margins. There are very few tech stocks with those types of growth and net margins that are trading below 30 times forward earnings. Yet Meta represents, I believe, one of the best opportunities within that kind of intersect between AI and if you look at kind of the future of what Apple has been trying to do with augmented reality with Vision Pro, arguably this is actually where Meta is beating Apple at its own game with regards to AR, both in terms of software and in terms of hardware. So this is where I believe, based on from a valuation perspective, Meta represents a far better value uh, way to play both artificial intelligence and the future of kind of AR versus a firm like Apple, which trades at a much higher valuation, has a much lower growth rate, has lower profitability metrics, and just from the overall outlook of their AI and AR um, outlook looks far more promising from Meta's perspective than it does for Apple, which is why I continue to pound the tables week after week and talk about why I believe Apple is overvalued and Meta is undervalued. Another stock that I want to point out here is Tesla. Tesla has certainly pulled back a pretty substantial amount here over the past few weeks here. It certainly has pulled back to a major support level, which was kind of the breakout level that we had here back in December. But we pulled all the way back here. And this is really where I think there's further downside risks here for Tesla. Tesla continues to trade at over 110 times forward earnings, and we've seen we've seen the risks here to the downside with Tesla and their competitors in the US, I'm sorry, in the Chinese EV space. BYD has continued to uh, send, I would say, shockwaves against the EV industry with regards to price cuts that Tesla has simply just had to eat into its margins in order to remain even remotely competitive. And arguably, BYD, from an innovation perspective, is currently at the forefront of the EV space. BYD continues to innovate from a product perspective in terms of launching new cars, new for different markets at price points that are far more competitive than any other car manufacturer. And Tesla simply is chasing BYD in terms of its dominance both in China and globally. So we're at a point where I think, um, while I am still a believer of Elon Musk and what he's capable of with regards to his companies, there's a substantial amount of downside risk in the valuation that Tesla is currently trading at, at about 110 times forward earnings, which, is simply just ridiculous in terms of the growth expectations that we get out of Tesla. At this point, we're now expecting potentially revenue decline, right? They've shipped less cars in 2024 than they did in 2023. And with further price cuts, we expect that potentially revenue could decline here in 2025. We also expect margins to potentially get hit. Net margins right now north of 12-13% is industry leading, but continues to see compression here in those margins. And uh, those things just simply do not add up to a valuation of 110 times forward earnings. It doesn't even add up to, something trading at 20 times forward earnings. So this is really where I see some substantial downside risks with Tesla's valuation here at the moment, and represents, one of the biggest downside risks, in my opinion, at the moment in the U.S. equity markets. On the flip side here, Visa is another one that we continue to like. Very similar to Meta, has had a very high amount of back-to-back winning sessions here over the last month or so, um, and still at the moment represents what I think is one of the best values in this particular space at the moment, trading at about 27 times forward earnings. Visa sounds expensive, but if you look at kind of the growth expectations for Visa, it is best in class net margins. Again, one of the few stocks with net margins that are north of 55% here, and just continues to print money as the entire world shifts away from cash into a more digital payments um, society that we have. And the more and more we continue to move our purchases from brick and mortar into e-commerce, the net beneficiary of all of that is Visa. And that's why, despite the fact that we are trading at all-time highs, Visa still represents, in my opinion, one of the best value plays at the moment. And I believe that there still represents a fair amount of substantial upside that remains in Visa. Um, we have pulled back on a lot of our plays that have kind of rallied substantially here this year, such as Disney, Lululemon, Shopify, Square. Those are the ones that, we have talked about here in previous weeks that we've maintained bullish views here. So, those have rallied substantially here in 2024 and into 2025. So, we're kind of re-establishing kind of some new ideas here for the week. And Boeing is one that we still want to reiterate as one of our top ideas for 2025, especially with the new CEO that is focused more so on increasing deliveries. He's gotten a lot of things that have been dragging Boeing as a aircraft manufacturing down, in 2024, and getting that past them here with labor disputes, concerns around safety, closing a new round of funding. getting much more hands-on as a CEO and actually moving to the Seattle area himself as a CEO. These are things that they've managed to sort of put behind them to some degree. And as you can see from the chart perspective, you have a stock that has underperformed the S&P 500 by a pretty significant margin for multiple years, starting to show some outperformance here. And we're starting to see the early stages of investors paying attention. And this is really where, Boeing trading at about 1.4 times sales is by far the cheapest from a valuation perspective in its industry. The industry median is about 1.8 times sales. Boeing trading at 1.4 represents a pretty significant discount, especially if you factor into growth rates that are substantially faster than the industry, right? Obviously, as it recovers from deliveries on both the 737 and 787 programs, um, it is expected to grow faster than its industry and net margins. We expect Boeing will turn up potentially a profit here in 2025. And that is what's going to drive, net margins back to positive net margins, similar to what we saw here prior to the extreme sell-off that we've seen here in Boeing, and represents a fair amount of upside opportunity here for Boeing. So we view Boeing as one of the better opportunities for 2025 here at the moment. So with that, that's kind of where we currently stand here from the overall equity markets perspective. There certainly are market internals that are starting to deteriorate that kind of shift our outlook here from the for the US equity markets in the short run to be a bit more negative here to the downside. At the moment, our view is that it's less likely that we're going to get a breakout to new all-time highs and continue this bull market here based on kind of where market internals are. But that is something that we will continue to monitor and update you on as that progresses. In the short run, hopefully show you some of the trade ideas that we have here for the week. And I would say two that I would focus on here this week are Kinder Morgan and Tesla. And then in the long run, there are some fantastic opportunities in names like Meta, Visa, Boeing, these types of names that represent, some substantial value plays here in the long run here for 2025. So that's kind of how I'm balancing the short term and the longer term opportunities here in the equity markets. And I'll continue to monitor that and update you here week after week. So with that, thank you so much. I hope you guys have a great trading week, and I'll see you guys here next week. Thank you so much.